Welcome to Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining us this afternoon, we have Scott Nations, president of Nations Indexes, and Kevin Kelly, founder and CEO of Kelly Intelligence. We're here to discuss what levels in the VIX and hedging activity are signaling about investor positioning. It is great to see the both of you, as always. Kevin, welcome back. It's been a while, and the environment is certainly different than when we met last time. I mean, the macro environment just almost superseded the moves that we saw coming out of earnings. It was almost an afterthought relative to what's happening, in the macro.
Yeah, and I think when you get out of earnings season, what really drives the market is the macro news and what's going to impact earnings going forward. And I think what's been pretty predominant has been two things. First, tariffs, right? So tariffs, there's a lot of uncertainty around that. When uncertainty happens, volatility erupts, and we've seen that happen over the last couple weeks, and there's still uncertainty going forward. That's why you're seeing that the VIX and the VXN, which is the Nasdaq 100 volatility index, is actually above its historical averages. And I think it's important to note too that there's also underpinnings in the technology sector because they are trading at higher multiples, because there is such a concentration in that when you see news, macro news like DeepSeek, where they have their own AI and it's supposedly cheaper, that does have a trickle on and macro effect on a lot of the technology names. So we're in an environment right now where macro news is really driving the market, and it's driving actually volatility pretty quickly.
Yeah, it certainly is. And Scott, you noted something interesting, that hedgers, they're refusing to pay up for deep out of the money puts. Does that signal anything to you?
It does, Jill, and it's really striking because, as Kevin pointed out, we had an eruption in volatility, but it was only in specific parts of the option skew. So, for example, everybody this time last week was happy to buy at the money puts because it looked like, to overstate it just a tiny bit, the world was going to come to an end. After a 117-point rally in the S&P on Friday and the rally today, not so much. But even in the worst parts of last week, hedgers were simply unwilling to pay up for deep out of the money puts, the sort of thing that would protect against a tail event. So, for example, TailDex, ticker TDEX, never closed above 20, hasn't closed above 20 in months. And that is just an indication when compared to Volley, VOLI, at the money implied volatility, or VIX, that traders didn't completely believe the story that equities were going to continue to break. I think there's also something else going on. Hedgers reached for those deep out of the money puts last August and then last December, and they just feel like I'm not going to fall for that again. So what does that mean? If they're not reaching for those deep out of the money puts because they think that the move is going to be sharp but contained, then that's actually pretty good news. If, on the other hand, they're just complacent, then that means they're not set up for a really ugly break in the market. That means that sort of break could cascade because they're just not hedged.
Yeah, Scott, I wonder if it's also recency bias, right? Where buying the dip became almost gamified, right? And it's it's been a while since there's been this type of prolonged volatility in the market. There are a number of traders who just don't have experience with this, and buying the dip is really all that they've known.
That's right. You are absolutely right. And recency bias is just the human tendency to give more weight to what we've seen recently as opposed to what we've seen over a longer term scale. And so the fact that you're right, buying the dip has been the way to go for a long time. And what's going to happen? Well, because of recency bias, people are going to continue to buy the dip until it doesn't work. And when it doesn't work, it's going to get really ugly. And then again, they saw that recently in August and in December, buying those deep out of the money puts didn't pay off. The market recovered very quickly. Those deep out of the money puts came back to earth very quickly. And so they paid a lot of money for hedges that didn't pay off.
Yeah, and Jill, I'd love to jump in here because I think one of the things that's been happening in the marketplace is that investors are noticing that the U.S. market is the place to be, right? If you think about where the earnings come from for a lot of the S&P 500 companies, it's overseas, at least half of them, especially in the technology sector. So when you're investing globally, you're actually investing in the U.S. listed names, especially the top tier ones, because there's hard to find competition against them globally. Secondarily, I think there's a lot of options out there, no pun intended, for investors through different types of ETFs, or even just going into zero DTE options where they're saying, listen, I like the market. I like the names. If you think about NVIDIA, people want to own that for the long term. If you think about other particular companies like Microsoft, when it comes to cloud and hyperscaling and everything that's going on in the AI race, there's names that they want to own for the long term. So they're using short-term vehicles such as zero DTE options, and that's why they're not and closest to at the money. So they're not going further out. So what they're doing is they're using these tools at the short term, closest to the money to hedge. So they're not doing as much spend as they normally would on, overall portfolio protection, but just for some near and immediate term protection. We're seeing that in the NDX options on our own. I mean, we've recently launched 2 products that actually own the long calls and the long puts, zero DTE on the Nasdaq 100 index, Q up and Q down. So we've had a lot of demand for that. So I think one of the biggest issues is people aren't necessarily overall worried about their entire portfolios and they like the names they have. They just want to use short-term hedging. So that's why they're not going further out and getting a lot of tail risk.
Yeah, well, you read my mind, so you made my job easy today. Scott, do you think the zero dated options, could that also be a function of investors and traders being hesitant to take longer term positions? Sometimes holding things overnight in this particular environment is challenging, to say the least.
I think it's a trader's market. Zero DTE is principally a trader's market, and that's fine. As long as you do it sensibly, you define risk. We pay attention to SPY, the S&P ETF. And so each day that we've been keeping track for the last several months, zero DTE options in SPY account for between 52 and 56% of the total SPY volume, which gives you an indication of just how important they are. This is also a situation, though, where people are going to trade them. It's going to work. Please define your risk, because there's going to be some sort of crazy event, and zero DTE shorts are going to be in a lot of trouble when that happens.
Yeah, and speaking of, there is a key event this week where the number could go either way.
Right. Yeah, and while and for example, the Federal Reserve is expected to do nothing, but they're really in a pickle, if you will. Growth estimates for growth for the Q1 are horrible. The latest estimate from Atlanta Fed shows that the economy is going to contract by just more than 2% in Q1. So what's the Fed do? Should they cut? Well, I mean, we're still worried about inflation. So how can they be cutting rates when we're worried about inflation, even if they're worried about growth? So they're expected to not do anything, but we know that Chairman Powell will speak, and that's what everybody will be queued up for.
Yeah, and it's interesting because, Kevin, this could go either way. If that expectation is in the market and it comes in better than expected, or not as bad as minus 2.1%, that reaction could be quite substantial either way, because there is this expectation of the number. And I feel like when it comes to economic data as well, there's a lot of noise in the headlines, but the data isn't quite as scary as some of the headlines suggest.
Yeah, and I think investors have gotten used to this, where Q1 has been seasonally weak. And also we've seen a lot of the previous economic data get revised downwards. So when it comes to this meeting coming up, and everyone's going to be focused on it, I mean, you're going to see at the 2 o'clock hour, everyone's, stopping and looking at this. And this goes back to sort of how people use zero DTE within their portfolios. If we look at actually the overall volumes, roughly 53% of zero DTEs are traded during earnings season, and then 47% is traded not during earnings. So it's roughly split down the middle, and investors are doing that because of these events where you have, whether it's the Fed speaking or even NVIDIA is talking this week about, it's mostly on the hardware side, but they're going to be impacting the semis pretty significantly. So you have these macro events, and people have these long-term positions where they're not going to touch them. So they're going to trade around these short-term options to hedge specifically these types of events, because there is such significant movement that happens with them. I can tell you that, everybody, talks about how it's priced in, they've got one cut or maybe two, but we never know where whether, the Fed's going to come in or what Jay says in his pressers. And we've seen most of those significant moves come during the pressers and during Q&A, and investors just aren't positioned for that. So there's a lot of volatility in these, especially when there's a lot of macro concerns. If you just look at the consumer discretionary side, a lot of those names have come down and they've gotten hit because of the tariffs and the cost of their goods sold. So if the chairman says something that's actually conducive to lowering rates and they may be accelerating that, you could see that consumer discretionary space pop right back up and have significant gains.
Yeah. That's a good point that you bring up, Kevin, too. When you think about it from a longer term perspective, some companies fundamentally and operationally, they're fine. It's just because of the headlines depending on what sector they're in, they're going to get hit. It's kind of like, what's the expression? All tides and boats or whatever, it might not be specific to the company, but, until there's strategies and more clarity, it's a guessing game. And particularly with the news cycle, and the distribution sources of where strategy is playing out does make it confusing, depending on your timeline. Again, if you're a longer term investor, it might not be as
super quick point on this too. This happened under the previous administration when Trump was in office. So when he was 45, we actually saw this sort of turbulent volatility. And because remember, he came out and he said he's going to do 30 to 50% tariffs on China. And so we went through the same thing. So traders and investors are actually conditioned to sort of this uncertainty environment to a degree. So this has happened before. There is a little bit of a precedent. It's anecdotal. It's one time, but we've seen this happen in the past.
Yeah. Well, Scott, let's think about it like this, right? So it took place just about 2 years when in 1.0, when President Trump was talking about tariffs. He goes in now, the velocity and the move is a little bit shocking, but the Band-Aid was ripped off. It's not like you're waiting, okay, is he going to announce it this month? Is it going to be a year from now? Midterms are coming up. At some point, there will be a resolution. So does it make sense to rip the Band-Aid off and just get it done?
Well, I'm not certain what is going to get done. And I think that, as Kevin has pointed out, that's the problem here. I don't believe anybody thinks that tariffs are a good thing. I think lots of people believe that they're a negotiating ploy and okay, but the risk becomes some sort of miscalculation. And I think we were actually pretty close to that with Canada. But it would be so much more facile and so much more damaging to have some sort of miscalculation regarding tariffs with China. And at some point, China has to play to its domestic politics, and they may just decide that they're going to unilaterally implement tariffs to satisfy their own domestic political concerns. Because they may say, hey, we're tired of being jerked around by President Trump. Let's get to it. And that would really be bad, because then you have this spiral of tariff and more tariff, and I don't know how you pull out of that before you hit the ground.
Yeah. Well, one thing's for sure is I don't remember politics inserting itself into the market as much as it has been, certainly over the past 6 to 8 weeks. Anyway, appreciate both of your insights. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.